Let's get right into it. You've got a legendary investor, the same guy who famously predicted the collapse of Enron, and he's looking at this massive AI boom and he's seeing a giant, glittering casino. His warning? It's pretty simple, really. If the prices stop climbing, the whole party could be over.
And this quote right here from the man himself, Jim Chanos, it just nails his whole idea. He thinks we're living in a time of pure speculation, where the market is less about finding real value and more about just placing bigger and bigger bets.
So what does he really mean by a casino society? Well, think about things like meme coins or even some NFTs. Chanos argues their only real function is to be bought and sold. As you see here, their entire existence is propped up by the belief that their price will keep going up. The moment that momentum stops, they don't just lose value, they could pretty much vanish into thin air.
But meme coins are just the appetizer. The main event, the highest stakes game in this whole casino right now, is artificial intelligence. And this is where Chanos thinks the biggest and maybe the most dangerous illusion is being played.
I mean, just look at this chart. The amount of cash being poured into AI infrastructure. We're talking chips, data centers, the whole shebang. It's gone practically vertical. This is what you call a capital expenditure, or capex, boom, on a truly historic scale. But here's the catch. Chanos warns that this explosion in spending is creating a seriously distorted picture of how healthy these companies actually are.
And that brings us to his big idea, what he calls the earnings mirage. It's this theory that the massive profits we're all seeing in the tech world, well, they might not be what they seem. It's almost like an accounting trick happening right out in the open.
So how exactly does this trick work? Okay, you can see the steps here. It all starts when big tech companies spend billions on AI chips. The company selling the chips gets to book all that money as profit right away. But the company buying the chips, they get to delay the cost, spreading it out over years and years. So what's the result? Well, corporate earnings look amazing, for now.
And the scale of this is just mind-boggling. We're talking $500 billion a year that these companies are spending. Chanos basically asks the question, can we really spend $1 trillion a year on all this stuff without seeing a real tangible return on it? At some point, the bill has to come due.
So you might be thinking, is this just some wild theory? Well, not according to Chanos. Because to really get his warning, you have to realize we have seen this exact movie play out before.
Let's not forget, this is the guy who famously shorted Enron. While pretty much everyone else was cheering its success, he was digging into their books and saw the red flags, like their return on capital being way too low. He saw through the game and made one of the most legendary trades in history.
And the parallel he's drawing here is pretty stark. Back in 1999, you had this massive spending on telecom gear, all fueled by hype about the internet. Today, you have massive spending on AI chips, fueled by hype about AI. And look what happened back then. When the spending stopped, corporate earnings fell off a cliff. That question mark hanging over today's boom, that's the thing that should make us all pause.
But here's the real twist. Chanos argues that the situation today could actually be even more dangerous. See, back in the dot-com era, it was mostly profitable, established companies doing all the spending. Today, a huge chunk of the demand for all this AI stuff is coming from unprofitable startups that are burning through venture capital money. If that VC funding spigot gets turned off, the demand doesn't just slow down, it could evaporate almost overnight.
So why? Why do we keep falling for this? Why do these massive bubbles seem to form again and again? Well, according to Chanos, it's not really about the technology, it's about us.
I love this quote because it just gets to the absolute heart of his argument. The software and the hardware, they evolve at lightning speed, but human psychology, our tendency to get swept up in fear and greed and just follow the herd, that's a constant that never changes.
And this timeline really proves his point, doesn't it? The specific asset is always different. It was the South Sea Company in the 1700s, dot-com stocks in 2000, and now it's AI. But that underlying pattern of human behavior, that cycle of insane boom followed by a painful bust, it just remains stubbornly the same. Which brings us all down to the one final critical question. If Chanos is right, and this is just another historic bubble playing out in real time, how does it end? And more importantly, when? Now, this is a really crucial point for any investor to understand. Back in 2000, the stock market peaked and crashed months before the bad economic news actually started to come out. The market didn't wait around for proof. It anticipated the whole collapse.
So if you're waiting for confirmation that the spending has stopped, you might already be way too late.
So, where does all this leave us? Is it possible that this time really is different? I mean, maybe the AI revolution is so profound that it just breaks the historical cycle, and maybe Chanos is just sounding another false alarm.
Or is he right? Is the music about to stop? Is that accounting mirage about to fade, revealing that this incredible AI boom was actually a spectacular multi-trillion-dollar bubble all along? That, right there, is the question we're all left to grapple with.